Welcome back, everybody, to the BizBeat by SVA, where we bring business owners and leaders the updates that matter most in tax, policy, and business strategy. I'm Lee Schwartz, Director of Business Development and Sales here at SVA Certified Public Accountants, joined as always by my partner in crime, Eric Trost, our tax partner and company president. Eric, how's it going?
Very good, Lee.
Good. Well, this is an exciting week. We've, as always, got just a ton of ground to cover. I think we're going to start with no tax on Social Security. At least that was the buzzword. We've talked about this a little bit, but can you talk a little bit more about what this actual deduction is and how seniors are going to be able to take advantage of it?
Right. So, no tax on Social Security. That was the tagline of the many taglines that were used in developing the One Big Beautiful Bill. How this ended up is that they couldn't really say no tax on Social Security in the process that they went through to create the bill. So they went through a certain procedural process that they have all their rules for. And within that process, they were not allowed to just exclude Social Security from income taxes. So instead, the alternative was they created a deduction. That's what they could do through the process to create this legislation. They could create a deduction. And the rule states that they created a deduction for $6,000 for each senior that's 65 and older. So you get your normal standard deduction that everyone gets when they file a tax return. There's actually an additional deduction that seniors get that's always been there. And now there is an additional further deduction of $6,000 that seniors get, which is meant to essentially reduce tax on Social Security. It isn't necessarily going to eliminate tax on Social Security, just simply reduce it. So a married couple gets $6,000 each if they're over 65, and a single just gets the single $6,000 deduction. This deduction is phased out, though, if you make too much income, like a number of these provisions within the tax bill. The phase out starts at $150,000 for a married couple through $250,000. So you lose 6 cents on the dollar of the deduction for every dollar you're over that amount. So let me give you an example is married couple that makes just right up to $150,000 and each of them are over 65. They're going to get the full $12,000 deduction. A married couple that makes $250,000 and they're each over 65, they've lost it all. They hit the top end of of the phase out. They're going to get an additional $0 of deduction. A married couple that makes $175,000, they're $25,000 over where the phase out starts at 150. So they're losing a quarter of the deduction. So the phase out goes over $100,000. If they're $25,000 over, that's 25% over. They're going to lose a quarter of their deduction. So if their deduction, they're each over 65, is $12,000. We're going to do the math here, Lee, and I'm going to test you. What's 25% of $12,000?
It's $3,000.
Very good. You could be a tax accountant.
I don't think I have it in me, Eric.
You could do it.
I can do 25% of things. I don't think I have your patience, but go ahead. Continue with the math.
Yes. So their deduction, then they lose $3,000. So their net deduction is $9,000. They start out with a $12,000 deduction. They lose $3,000. So that nets to a $9,000 deduction. Now, these numbers are split in half for single individuals that file tax returns. Their phase out starts at $75,000 and they lose out on all the deduction at $175,000. So if they make $75,000 and this individual is 65 years old, up to $75,000, they get an additional $6,000 deduction. If they make $175,000 and they're 65 years old, they get an extra $0 deduction. And so their deduction phases out likewise for over 100,000. It goes from 75 to 175.
Okay, so now I'm going to turn it around and I'm going to have you do some math. So you talked about the standard deduction then. So maybe help walk us through then what this $6,000 senior deduction means for somebody who is making less than, say, $100,000. So the standard deduction plus this other one that you mentioned was already in there, plus now this
Yeah.
new one.
Yeah, and
What does that drop people down to?
yeah, so I think what you want to focus on is what did this $6,000 do to your tax liability? And so it depends on what rate you are. So let's say you make $100,000, you're going to be about the 22% rate. That $6,000 means that your tax liability is going to be reduced $6,000 times 22%. So that's about $1,300, let's say.
Okay.
So that's about what it equates to. Now, what we don't know yet is does that deduction count for Wisconsin or Colorado or any of the other states that an individual might do their income tax return in? So, what you're looking at is those states have to adopt or not adopt these federal rules. And the states usually do that sometime around the end of the year, and certainly will have to do it quickly this year because the deduction is good starting in 2025. So, this year. So at the end of this year, when you're getting your tax returns done, that's when you're going to start taking this deduction. By the way, this is a temporary deduction. And what that means is in 2028, it goes away. So after 2028, it goes away. They can take this deduction 25 through 28. That means if it's going to be renewed again, it's going to take a literal act of Congress to get this back renewed.
Right. A literal act of Congress, which
That's right.
is right. Just as bad as a figurative act of Congress. Okay. So, just as a reminder, so remember, we've got a lot of this information posted on our website at sva.com/OBA. We've got all sorts of information there. Head over to that landing page if you're looking for additional reading material, which I'm sure you all are. So, Eric, let's move on to there was some new IRS guidance. We talked, a couple months ago about how there's going to be a lot of guidance coming out about all these changes that were in the big, beautiful bill. And some guidance just hit. You want to give us an update on what that was?
Yeah, so in late August, the IRS issued some guidance related to the phase outs of the clean energy credits. So recall the one big beautiful bill extended a lot of provisions from the 2017 Tax Cuts and Jobs Act. It added some new and exciting things such as the no tax on tips, no tax on overtime, and this new senior deduction that we just talked about. But what it also did, these are not taxpayer friendly things, is it cut out some of the credits that were previously available for clean energy cost implementation. So, for example, there has been a $7,500 credit to buy a clean energy car, in other words, an electric car. That's being phased out. And so, as of September 30th of this year, so 3 weeks away from the taping of this, they're not going to be available to take that credit anymore. So that was a rather popular one. That's going to be gone. There's also some residential energy credits that are phasing out at the end of the year. That would be to like put solar panels on your house or geothermal. So these credits, which had been around for quite some time, are now being phased out. Essentially, being the plugs being pulled on these, and so there won't be an opportunity to take these credits anymore. If you are thinking of going and saying, I want to take advantage of the clean energy subsidies that are out there in the form of these credits, has to be done quickly.
Yeah, so get on that. Sounds like that is going away. Eric, anything else that you're seeing as far as the clean energy credits go, or any other guidance there you want to cover?
Yeah. So the only thing I'm seeing is that there is some general complaints about it on the site formerly known as Twitter. I think they call it
Well,
X now.
wait, hold on. We've got breaking news here. You're telling me people on Twitter, people are complaining?
That's weird,
That's
eh?
that is surprising.
It's almost like this other site, Reddit. Sometimes get people complaining
Or
over
the
there too.
internet as a whole.
Yeah.
But anyway, okay. Well, you heard it here first, folks. All right. Well, let's move on to our mailbag. Remember, everybody, you can send us your questions, email them to us at bizbeat@sva.com, or you can submit them at sva.com/bizbeat. So this week's question, Eric, we've got a few questions on these related topics, but this week's question is how do qualified charitable distributions work? Can you just explain that for our listeners?
Right. So, and this rule's been around for a while as well, and this has not been touched by the one big beautiful bill. So, qualified charitable distributions is a tax planning trick for those that are normally required to take what's called required minimum distributions. It's generally for people that are 70 and a half and older. And what you can do with a qualified charitable distribution, which is QCD for short, so you might see QCD mentioned in the planning materials, is that instead of taking your required minimum distribution from your IRA, you can give it directly to charity and you don't have to include your required minimum distribution then in income. Now, that's important for a couple reasons. And so let me give you some background on that. Required minimum distributions rules were put in place so that you could not keep your IRA, which is an untaxed account until the money comes out, you could not keep it forever. So at the age of 70 and a half, and actually that age is slowly moving up with recent legislation, it's going up to 72 and 75. But at those ages, depending on when you were born, you had to take your a distribution out of your IRA, and that distribution would normally be subject to income tax. So you'd take it out of your IRA, you'd add it to your income, you'd pay tax on it. That was to start to slowly deplete those IRA assets that were otherwise sheltered from taxation. Now, what a qualified charitable distribution allows you to do is to give it right to a charity. So the amount goes from your IRA and it goes right to a charity. Now, you might say, well, why would I want to do that? I mean, I could just take the money out, include it in my income, and then give it to charity and get a charitable deduction. Isn't that the same thing? Mathematically, it looks like the same thing, but it's really not. And the reason is a couple reasons for this. One is in order to take a charitable deduction and take advantage of it, you have to itemize your deductions. With the standard deductions being so high, not everybody can itemize their deduction or it's not advantageous to. So, including your required minimum distribution and income, and then trying to take it as an itemized deduction, you may actually go backwards because you don't get any benefit from it. A second thing is that once you include your required minimum distribution and income, it increases your income level. Now, why is your income level higher a concern? Well, one of the concerns is the higher your income level is, things get phased out. For example, we just talked about the senior deduction that starts to get phased out at $150,000. A required minimum distribution adds to the income that could cause that phase out. So again, if you take the required minimum distribution out and you give it to charity, it adds to your income. You could actually lose your senior deduction. And so you're paying even more tax than you thought you would be if you just take the money out and then give it to charity. So this allows you to take that required minimum distribution out, give it right to charity, and bypass it going through your income. By bypassing it going through your income, you might be preserving things like the senior deduction.
And Eric, is there a benefit to the charity as well? Is there an impact for them if you're taking $50,000 out, paying the tax on it, and then donating it? Is that the same as a QCD?
Yeah, so the charity doesn't know if you're doing a QCD or not, and it's transparent to them. So they don't see a difference if they get 50,000 one way or the other. There's no strings attached because it comes from your IRA. They don't have to use it a certain way. So the charity itself gets the benefit of getting the contribution. And what the charity doesn't see, though, is what happens on your individual tax return. So when
Okay.
you set this up, this is purely to get a better answer for your own taxes and still complete your charitable wishes.
Okay. I guess my thought was, and maybe I'm confusing this with something else, but there are times when, let's say you're making a $50,000 contribution to a charity. If you are paying $10,000 in tax, maybe you're giving $40,000 to the charity. In this case, if you're donating straight from your IRA, the charity's getting the full 50,000.
Yeah, that's right. But the charity itself, I mean, you're talking about, say, a tax effect for an individual that's making a gift. The charity itself, I think, just ends up with whatever cash is there. So if you're trying to figure out what is this going to cost me by giving to a charity, and I'm going to net that out in some equation, the charity is going to get less. But normally, I think what people do is they make a commitment to a charity, and let's say the charity is on a fund drive and they want to accomplish a certain thing, and raise X dollars in cash. So they're just looking to raise that X dollars in cash. And you're saying, okay, I'll be part of that. And my part of that, let's say, is going to be $50,000. I can use my QCD, and it's a better tax answer for me than if I took out my required minimum distribution and then gave it to charity.
Gotcha. Okay, great. Thank you for walking through that. And forgive my questions. This is why I couldn't be a CPA. You see, I ask.
I'm retracting my last offer for you to come and be a tax accountant.
It's okay. That offer was not going to be accepted anyway. So we're both on the same page now, at least. No, but it sounds like a great way for retirees to support charities and reduce taxable income at the same time. So thanks for walking our listeners through that. And Eric, that's going to do it for this week's episode of the Biz Beat by SVA. Just a reminder, you can go to sva.com/OBA, OBBBA, for our OBA hub with updates, webinars, recorded ones, upcoming ones, you name it. We got a ton of information there. And just a reminder, subscribe on Apple Podcasts, on Spotify, and on YouTube. And please share this with someone you think would find this helpful. The more business owners we think hear this, the better. For us, for them, for everybody. And as always, the information we share here is general in nature. So talk to your CPA or your advisor for guidance on your unique situation. And if you don't have a CPA or advisor that you can rely on, please contact me and let's fix that and get you a good one here at SVA. Thanks again for listening, and we will see you next week on the Biz Beat by SVA.
From tax tips to business trends, smart insights from trusted friends. The Biz Beat by SVA.